Well, good afternoon, everybody. I'm Ric Edelman. Thanks so much for joining us for today's webinar, Crypto for RIAs. We're going to talk about yield, staking, lending, and custody going far beyond the Bitcoin and Ethereum spot ETFs, which have captured all the attention this year. Joining us for this conversation, I'm very happy to welcome on Bill Barhydt. He is the founder, CEO of Abra. Bill, glad you're joining us on the program today.
All right.
It's good to be with you here, Bill. Bill has been in the crypto space pretty much from the beginning. He gave the very first TED Talk on Bitcoin way back in 2012, when still most folks had never even heard of it. That was the year I was introduced to Bitcoin. And yeah, Bitcoin was just $5 at the time you gave that TED Talk, Bill.
Yeah, I think that's right. Silk Road was raging, and nobody knew what else it was good for, and here we are, 13 years later.
I think that the explosion of popularity, engagement, curiosity about crypto broadly, Bitcoin particularly, is beyond anybody's wildest expectations. Talk about your engagement in this space and Abra. It's a pretty well-known name in the crypto world, but not so much in the financial advisory space. So talk about Abra.
Sure. So we've been at this for about 8 years. We're a digital asset firm. We help people, companies get access to the digital asset space, and we do that in different ways. We have our prime brokerage service that helps digital asset native companies buy, sell, trade, borrow against crypto assets. And we have our wealth advisory service, which we're mostly going to be talking about today, which helps all kinds of investors globally get access to the digital asset space, as well as family offices, corporate treasury, et cetera, et cetera. And like I said, we've been doing this for quite a while. We're an SEC registered investment advisor, and as such, we act as a fiduciary for our clients who participate with us through our RIA, as I know many of the folks participating in this call are as well. I think we're very unique in that we're the first, we may be the first, I'm not sure, but I believe so, the first RIA in the space that actually provides yield and lending services, as well as separately managed accounts for digital assets.
I think that that's a really key element here that we really need to highlight, is that I think a lot of advisors watching this are going to be surprised at what you just said, that you're an SEC registered RIA. I mean, the typical attitude, and I think this is generally true, is that you've got crypto industry and you got the financial services industry, and the two don't cross. I mean,
Right.
so here you are as a crypto company that is a registered investment advisor. So talk about your bridging that gap and your background as to, did you come from the crypto space and moved into RIA for regulatory reasons, or were you from the Wall Street world and recognized the opportunity in crypto?
Yeah, I'm probably unique in the crypto space in that I long before even the internet, I was at Goldman. Well, before the commercial internet, I should say. I was at Goldman Sachs, and I was in fixed income, and then I worked at Netscape on the early days of the internet. So I understand the tech really well, and I understand capital markets really well. And so I recognized very early that there was a huge opportunity here, effectively, to provide banking, investment, advisory services to investors, companies in the digital asset space. And obviously, the manner in which one can do that has been evolving over the last several years, both from a regulatory perspective, in terms of what products are available, the technology stack, people's understanding. And like you said, when I gave that first talk 13 years ago, I'm not sure how many people actually understood what I was talking about. And I think now there's probably a lot of people on this call that are holding digital assets, so times have changed. But I think we're pretty unique in terms of our understanding and ability to bridge both worlds, the digital asset world, the traditional finance world, understand the kind of compliance and legal requirements for working in the overlapping area of both worlds, and how to provide a viable customer experience in a world that is scary and complex to some people.
And this is why I think it's worthy of advisors and firms to pay attention to Abra, because I think there's been a legitimate concern by advisors about engaging in the crypto space because let's face it, as you well know, Bill, as I've discovered over the past decade, so many people in the crypto world just don't get the financial services industry. They don't understand it. Many are dismissive of it. They disdain or even ignore regulation. They don't understand the world of compliance.
Yep.
And I can understand why a lot of folks in the RIA community are like, I don't want to deal with these people. They don't talk my
Right.
language. I don't
Right.
want to put my firm, myself, my clients at risk.
Yeah.
But I'll say this in a rather direct way. You're one of us, and so you get
Yeah.
it because you grew up on the Wall Street side. And I don't know of too many other firms in the crypto space that are registered RIAs. So
That's right. That's right. I'll say two things to that. One, I do believe that wealth management, advisory, banking, it's all going to be changed 100%, 180 degrees in the next 10 years, 15
how do
years.
you mean change in what way?
Because digital assets are going to become a key enabler of everything. Now, I'll explain why in a second. Our goal is not to treat the existing business with disdain. It's to basically help the existing businesses come into the new world, right? When I was at Netscape, we tried so hard to convince existing businesses, the blockbusters, to come into the new world. Many made it, many didn't. And our goal here is very similar. We fundamentally believe that the future is digital, right? The future is going to be smart contract enabled. Everything is going to be tokenized, right? We're just in the early stages of giving investors exposure to this asset class via Abra and building a platform to do that, and hopefully educating everyone along the way as this new wealth and banking space emerges over the next decade.
We'll talk very fundamentally. Why does this matter? Who cares? Why are we bothering to do all of this effort? Why bring the digitization, the tokenization,
Yeah.
the DeFi environment into the Wall Street financial services sector? What's the point of it all? Why is it
Yeah,
needed?
I'll break it down into three key areas that I think matter. The first is the dollar, right? So the dollar and related bond markets have been the pillar of unprecedented economic miracle for the last 75 years. But we're now at a point where people recognize that inflation, the dollar, bond markets, the Fed just lowered rates and yet treasury yields are going up. That's not supposed to happen. What's going on? Something's breaking, right? And so people are recognizing that the 60-40 model, the dollar hegemony, there's just something wrong, right? The Occupy Wall Streeters understood it. They just couldn't explain why, right? But now we're starting to get some clear indications that the buckling at the seams, and it doesn't look like there's any going back, any path back to the way things used to be. And so having first Bitcoin as a digital asset that showed us that we can actually create something which represents a pristine, digital asset in terms of, it's unconfiscatable. You can't print more of it. It's mathematically hard coded and hardwired to only exist in a certain amount, right? We never even thought that was possible before. So that's kind of part one. Part two is that we now have this, on top of that, this smart contract technology that we're able to use to do things like tokenize a dollar and earn yield on a dollar, right? Without having to basically use centralized actors to do that. And beyond that, we're now at Abra able to provide access to those yield products, right, in a very safe, accessible manner to the average investor. And then the third piece that is really coming now via these smart contracts is this idea of decentralized lending, and that's one of the fastest growing aspects of our business. So a lot of early Bitcoin, Ethereum, even Solana holders are now borrowing against their digital asset holdings, just like you would have a HELOC loan against your house, a home equity line of credit. They're effectively getting a digital asset based line of credit where they're using the crypto digital assets as collateral using smart contracts to facilitate the loan. So they're not actually even entertaining counterparty risk in the model. In other words, if the HELOC lender goes bust, what risk are you taking as a homeowner, right? Well, here you're not taking that risk because you're not actually borrowing from Abra. You're using the technology to do the loan. So between this idea of a stable reserve asset in Bitcoin, the ability to tokenize assets and earn yield, and lending, it's a new era, right? And the number of kind of millennials who are bypassing traditional investment opportunities and going right to this is remarkable. It's truly remarkable.
We have a lot to unpack here, and invite all of you watching to join this conversation. If you have questions, many of you have already written in questions when you signed up for the event. We'll weave them into the conversation here today. And if you have questions here on the fly, go to the Q&A section here on Zoom. I'll be checking that and curating it, and I'll be peppering Bill with those questions that you submit as well. So I want you to be involved. So talk about that notion you just mentioned of no counterparty risk, no reliance on a centralized authority, meaning that's code for banks, right? Mm-hmm. So I don't need a bank account. I don't have to qualify for a loan via a bank. I don't have to have the bank as an intermediary in facilitating the transaction as I'm trying to borrow money. And the reason I want to borrow is because I've got a lot of build up capital gains. Those lucky few who bought Bitcoin at $5, they're sitting on massive capital gains. They don't want to sell their Bitcoin to pay the tax. They're going to borrow against it the way that rich people borrow against their artwork and their real estate and their stock holdings. And this is why Warren Buffett doesn't pay any taxes. He just borrows against his holdings. So do you see Abra and the Abras of the world ultimately replacing banks?
I mean, it is the future. So think about it this way. Okay, when you make a deposit at a bank, your deposit is a liability on the bank's balance sheet because you have lent your assets to the bank to make it a liability. Okay. So it's no longer your asset, it's the bank's liability. Okay. So what we're saying is the better way, right? And the perfect examples, I just saw a question about Celsius, is that Celsius was running a centralized lending pools, which worked just like a bank. So when the loans went bad and everybody was pooled together, it would be just like a bank going bust minus FDIC insurance.
Right.
In this model, what we're saying is you actually retain title to your asset. Okay. And the loans and the yield are you directly deploying into DeFi. Now, we've curated using our own balance sheets different DeFi opportunities for both yield and lending to know what we're comfortable with because we've tested them. They have, total value locked in many cases of billions or tens of billions of dollars, but you're not taking counterparty risk to Abra in that transaction. And I believe this is the future of investing. It's probably the future of banking. And it's certainly the future of, how we plan to run our business at Abra. And it's the way this type of business should be run. You shouldn't have to worry about the viability of Abra if you're using digital assets, right? You just basically use the technology the way it was meant to be used. And, it's working. It's one of our fastest growing products is the ability to do yield, staking, lending, all via, this new smart separately managed account model where you retain title to those assets, as I explained.
So talk about the logistics of how this operates. As a registered investment advisor, you open accounts on behalf of investors. Do you also work with the advisory community so that you're a B2B2C play? Is that how it functions?
Yeah. So today we sell direct to investors, and we act as a qualified custodian for them in the digital asset space using it's called MPC technology. We partnered with a company called Fireblocks, who's the leader in providing that custodial technology. And each client, again, effectively is getting a vault. Think of these as individual client vaults. And that's why you're able to retain title to your assets because they're not pooled together. Your Bitcoin stays your Bitcoin, your Ethereum, your Solana stays your Solana, et cetera, et cetera. And today, like I said, we're selling that direct to investors, B2C, as you said. And we're now working and having discussions with lots of RIAs to potentially allow RIAs to offer these services to their clients as well. And that, as you called it, B2B2C. And that's something that I believe is a big part of our future. And we're learning what the individual requirements are, because many RIAs have different platforms, different internal compliance requirements. But we are putting those pieces in place, having those discussions actively. So folks, if that's something that you're interested in and you're online as an RIA, definitely get in touch with us after, and we'll include you in those discussions as we plan that out.
So advisors could actually participate in the beta testing as you design this program.
That's right. That's right. And somebody was asking about DeFi regulation, by the way. And I would say the internet itself is not regulated insofar that, the way the ones and zeros travel is not regulated by any financial regulator. You're talking about the movement of ones and zeros. And you're also talking about smart contracts that can't be stopped. They can't, in general, we're talking about smart contracts that have been audited, running for, in some cases, years now, with zero hacks and very impressive what these systems have managed to do. We've simply integrated it into the qualified custodian model so that the investor, with all of the appropriate risk disclosures, can access those investment opportunities directly.
So we're getting lots of questions. People are really interested and curious about everything that you're describing here. Does this whole concept, is it of value or is it of interest only to advisors who are actively engaged in the crypto space, meaning an advisor who is recommending Bitcoin to a client, or is it broader than that?
Yeah, so I would say a couple of things. One, the ETFs, let me talk about it in the context of just Bitcoin and then the broader space for a moment. My humble opinion is the Bitcoin ETFs have been fantastic marketing for the space, because, once something like that gets approved, you basically know that the custodians are real, that the processes are real, the settlement is real. But our opinion, having worked on this for years, is that the average, especially high net worth and family office type investors, upper middle class, this is not the optimal way for them to get exposure to the space, in our opinion, right? You're foregoing yield, you're foregoing the ability to invest in multiple digital assets, right? Solana, Ethereum, Sui, Aptos, other stuff that's coming next that we get a lot of requests for, and you're foregoing the ability to borrow against those assets. So for our kind of typical investor, it's not how they want to get exposure to the space. Not to mention that crypto and digital assets trade 24/7. The ETFs trade 33, 34 hours a week minus holidays, which is, very risky for some people, depending upon their strategies. So beyond that, I would say, just the ability to stake proof of stake assets like Ethereum, like Solana, the ability to earn yield on Bitcoin and your dollars that you're holding in the system has proven super compelling to our clients. And I think this is part of the future of digital asset investing.
So you're arguing, if I can interpret, that an advisor who isn't actively recommending Bitcoin would nevertheless say to a client, do you own Bitcoin? And if the client says, yes, I own it, the advisor can say, well, let me show you how to do this better than the ETF. Let me show you how to do this in a manner that is better than you just holding Bitcoin in a Coinbase account. Let me show you how to transfer that to Abra, where you can engage in all of these additional strategies and in fact go beyond Bitcoin to other digital assets as well. That's kind of what you're saying.
That's right. We get a lot of clients who are coming in from Coinbase, coming in from other custodies, hardware wallets, who basically want the registered investment advisor environment of a qualified custodian, want to earn the yield, think they might want to borrow against Bitcoin in the future for their home, for college, lifestyle loans, whatever. And yes, it's becoming a very common discussion and refrain at Abra for sure.
So we're getting lots of questions here. Let me ask you some of these. Corey has asked, do you have to be an accredited investor to
No,
open
we
an
don't.
account?
No, we're an RIA just like many of you, and as such, we can deal with any retail investor, not even isolated to the U.S. We can take investors in most countries.
And questions, elaboration on Fireblocks. A couple of folks are asking this, who
Yep.
not familiar with Fireblocks. So elaborate a little more. Who are they exactly? What do they do?
Sure.
What's your relationship with them, and so on?
Yep. Fireblocks is considered the premier custody service provider in the United States. Many banks use them. TradFi companies use them. They use what's called MPC, or multi-party computation. It allows you to have separate instances of keys, and if you use correctly, it's really a rock solid platform. And you know, to my knowledge, they've never even come close to suffering a hack or a data loss on their own. And so, you know, we've been working with them for gosh, I think since the beginning, but probably 4 to 5 years at least now. Yeah.
So rather than doing that functionality yourself, you're simply outsourcing it to them.
That's right. And then we act as the legal qualified custodian, as the RIA, but they are the tech stack provider in that specific instance. Yeah.
So explain how that relationship works. You got three parties. You got the owner of the Bitcoin. We have Abra, and we have Fireblocks. I own Bitcoin. I have it in a Bitcoin wallet. If I'm going to engage in the strategies you're describing, where's the Bitcoin? Where's that wallet?
Yeah.
How does that all work?
You get your own instance or vault, if you will. It's like, you know, if you had basically took your hardware wallet and put it in an encrypted cloud that no one else could access, it's physically your vault. So in other words, there's no commingling of my Bitcoin and your Bitcoin, right?
And this vault is at Fireblocks.
Exactly. And then on top of that, our SMA platform, separately managed account platform, gives you login access to your digital assets to deploy for yield, to see your balance, et cetera, and then effectuate deposits and withdrawals. So, you know, you can get your own unique deposit addresses for any digital assets you may already own that you wish to move over, but they're not moving into some central storage location. They're moving directly into your vault.
Got it. The biggest issue in the world of crypto for advisors and their firms is the notion of custody. So within all of this, who has legal custody?
Yeah. So the client is retaining title to their assets. They have legal custody over their assets.
So you don't have custody. The
Legally,
advisor doesn't have custody.
We're providing the technology to manage the custody. Legally, the client retains title and has custody to their assets at all times.
Great. And that's a hugely important point, as you know, because nobody wants to go anywhere near custody in our space.
Yeah.
You mentioned Celsius, and Corey has another question related to that. Celsius, of course, went bankrupt, one of the big blow-ups. Terra Luna was another stablecoin outfit that blew up. Differentiate what you're doing and how you're doing it that makes it so that what happened to Celsius cannot happen here.
Yeah, exactly. I'll give you two concrete examples. So the first is, again, you're retaining title to the assets. And so what the last generation of lenders, the Celsius and BlockFis and Voyagers, were doing is they were pooling everyone's assets. You became a liability on their balance sheet, just like a bank, okay? And then they were paying yield by lending out those assets to hedge funds and other sellers of those assets, right? Just like a prime broker would do. The problem is when those loans went bad, everybody's assets were pooled together and they had all this counterparty risk, and they had to figure out whose assets were whose via bankruptcy court, okay? And that's not the right way to do this. The right way to do this is each client retains title to their assets, number one. Number two, when you generate yield, you use staking platforms that don't have centralized counterparty risk. In other words, Ethereum staking, Solana staking is fine because there's obviously no counterparty risk, you're just staking. But if you want to earn yield, for example, on Bitcoin, we actually use DeFi protocols that over collateralize, right, the counterparty to the yield. Now, to prove my point, when Celsius was in bankruptcy court, the judge put a freeze on Celsius repaying all of their loans. But Celsius actually went ahead and repaid a loan to the DeFi network. The judge called them in immediately and said, "What are you doing? I told you not to pay back any loans." And the judge had no idea how DeFi worked. The judge, the people from Celsius's administration explained that if they didn't pay back the DeFi loan, they were going to get liquidated, on their collateral, and there was nothing anyone could do to stop it because it was DeFi. And once the judge understood, he said, yes, okay, you did the right thing. Thank you for explaining to me. I wish I'd explained it sooner, but thank you for explaining to me. The point being that DeFi is the right way to do this, right? You're eliminating centralized counterparty risk. You're no longer taking a risk on Abra. Your focus is on the protocols and the network where it should be. We're simply
let's talk
easy to access.
Let's talk about the whole profit motive here. You know, obviously the only reason people are investing in crypto is because they think it's going to prove to be a profitable asset, or they would otherwise buy stocks, bonds, and real estate if they didn't feel that way. One of the complaints that people have raised about Bitcoin, and frankly, pretty much most other digital assets, is that it's kind of like a growth stock. You know, you invest in it and you're hoping it rises in value because, you know, growth stocks don't pay dividends. So all you have is the opportunity for appreciation. There's no income, there's no yield. And Ethereum now offers that opportunity. That's what staking is all about. When it moved from proof of work to proof of stake, it now generates a yield potential, which is one reason people are more excited about Ethereum in many cases than Bitcoin. Solana is a similar protocol. Bitcoin, however, still the dominant asset in the crypto space with 60% of the market value, has no yield. So it's dead. It's a dead asset, excluding the appreciation potential. You're solving that problem by creating a yield opportunity with Bitcoin. Explain how.
Yeah, there is significant demand for people borrowing and lending within, you know, the digital asset space. These DeFi protocols effectively act as lending pools. So if you want to borrow, let's say, for example, dollars, right? You might park Bitcoin as collateral and borrow 40, 50% of that. You might park Ethereum as collateral and borrow Bitcoin for temporarily, for whatever reason, also over collateralized. Each participant in the network is actually paying interest on whatever it is that they're borrowing for whatever reason. That enables the yield that I'm talking about, but each participant is over collateralizing whatever they're borrowing, right? Just like nobody can borrow more than what their house is worth, right? In this case, you can't usually like less than half, right? So that over collateralization is what makes this a relatively safe yield, very safe yield model. It's how I do it. It's the only way that we offer yield via our RIA today. There was also a question related to this that the SEC was suing intermediaries who were offering staking products. They are not suing RIAs offering staking products. They're suing everyone else. That's why we did it this way, right? We had a product that wasn't an RIA. And, you know, we had, after discussions with the SEC, the decision to shut that down and form the RIA explicitly to do this in a way that would pass muster with the existing qualified custodian and RIA and risk disclosure rules. It's the other companies, the Coinbases, that are getting sued for offering staking that aren't doing the registrations and hence all the risk disclosures, that are actually in legal disputes and lawsuits with the SEC, and in some cases, state securities regulators as well.
Why do you suppose the Coinbases of the world have not registered the way that you are?
I don't know. It's a lot of work. That I know. I mean, building out this model. Look, they make most of their money on trading. Okay, so when you stake in a trading account, your assets are available more or less to trade 24/7, which is how they make their money, right? We're a fiduciary who gets, you know, asset management fees from our clients, and as such, our interests are aligned with our clients. I'm not going to speak on behalf of Coinbase, but I'm not 100% convinced that their interests are aligned with their clients' interests as an exchange, as opposed to a fiduciary. It's a very different set of responsibilities, as you know, very well know.
And in fact, you've mentioned fiduciary and qualified custodian a couple of times. That raises a question from one of our listeners of a little bit of confusion. If you're the qualified custodian, but the client has custody, that seems to be, you know,
Yeah, it's a
non
function of
sequitur.
how the MPC technology works. So we're managing one of the keys, and we actually provide backup for the keys, but legally they're retaining title to their assets. So that's what I meant when I said that they have custody. Is legally they're retaining title. That's the legal expression, but we're helping them manage the keys for sure. We have an encrypted backup service provider that maintains that backup. Should Abra go away, for example, that would guarantee that they have access. That's hopefully that clarifies.
So you mentioned that you might post, you own a bunch of Bitcoin, or your client does, and they want to create some liquidity, but they don't want to sell it and pay taxes. So they post it as collateral and borrow against it. And by borrowing against it and posting it as collateral, those Bitcoins become available for somebody else to use. And you said there are a lot of reasons people might want to borrow somebody's Bitcoin. Can you provide some examples of what those reasons might be?
Short-term purchase that requires Bitcoin versus a different asset. Short sellers. There's lots of reasons, right? The most important point is that they're providing more collateral than they're borrowing, right? Just
Meaning
like
that you're putting up $1 worth of Bitcoin, but you're only going to be borrowing 50 cents of it.
correct, or you're putting up $100 worth of Ethereum and you're borrowing 25 cents worth of Bitcoin. And this
And
is
why is it that that ratio is like you're describing?
because that's what the system requires in order to prevent anybody from gaming the system and ending up stealing money. Because if I could borrow 110%, I would do that all day and just drain the system of all the assets, right?
But there's also a risk, a more practical reality, I think, is the risk of a margin call.
Exactly. And that's related to one of the questions I saw, which is how lending and collateralization deals with the price volatility. So these DeFi protocols don't let you borrow like more than 70% of the current value of the asset. And what happens is our system, let's say you are doing a loan. If you're doing yield, it doesn't matter. You're protected. You're fine. If you're doing a loan where you've posted collateral, let's say that you've posted enough collateral to borrow 50%. So you've deposited $100 worth of Bitcoin and you've borrowed $50. If the price of Bitcoin falls so that your LTV goes from 50% to like 75%, you run the risk of starting to get some of your Bitcoin sold. Right. And our system will send you notifications, hopefully long before that happens, so that you know that you may need to deposit more Bitcoin, right, or pay down some of the loan, whichever, in order to avoid having some of that Bitcoin be sold. Now, we recommend to our clients that their loans are in the 25 to 35% loan to value ratio range. In other words, they're only borrowing, let's say 30-ish% of the value of the Bitcoin. So they're
because Bitcoin is so volatile.
Exactly. And in that case, we've never had anything close to a liquidation. As a matter of fact, we have a lot of clients who aren't even paying the interest on their loan. They're just rolling it over into principal because they believe that the price of Bitcoin will not only continue to rise, but rise fast enough where they'll just keep borrowing against it and not even pay back the loan.
So talk about the fees of all of this. What does it cost for somebody to do all this?
Yeah, we take management fees. So it depends on the product. We have just straight up custody, yield, and then lending. And the fees range from 1% to 2%, depending upon which product the client is using. Of course, they have trading access. If they're holding, for example, stable coins and they want to trade into Bitcoin, there's standard, spread on rates on trading. But in general, think of a 1% to 2% yearly management fee based upon which products they might be using and the complexity of those products.
And is this available to investors and advisors in all states, or are there any limitations?
Yeah, as an SEC advisor, we're able to provide access in all 50 states. To my knowledge, we have no limitations on any type of client that we can service today in the United States. And like I said, we're now getting into the point where we are interested in looking at working with advisors as well, which we think is a fantastic opportunity, especially with the next generation of investors who, in many cases, are completely bypassing not only the 60-40, but just the traditional investment opportunities altogether.
So one of our listeners, viewers, has asked if you've got a deck, and we do. So Bill has produced a deck. We're going to push it out to you right now so that you can download it and look at a lot of the content that Bill has put together that describes what Abra does and how it does it, and a lot of information as well. So there it is, pushed out to you. So I encourage you to download that document. It'll also give you opportunity for contact info so you can reach Bill if you have further questions or interest in pursuing what Abra does. Reginald's got a really, really good question. We really need to take a step backward, Bill, because a lot of this is still, as you know, confusing to advisors who are not
Yep.
well versed and experienced in crypto. So let's
Yep.
take a step back. Define the difference between yield and staking.
So yield, it usually comes from a lending, right? So I deposit an asset or I provide an asset to someone. They provide more collateral than the asset, right? That they're earning yield on, right? And so that interest that they're paying is paid out in yield. As the person who's depositing, let's say, my dollars or my Bitcoin, which are non-stakeable assets, right? And so the DeFi protocol manages that so that everything in the system remains kind of over collateralized so that the way I earn yield is very safe. Just like when you have a treasury, you're assuming that the government is able to pay it back. The difference here is that instead of the US government not providing any collateral, everything here is collateralized. Okay.
And the yield is paid in the form of
whatever you deposited. So if you deposited Bitcoin, the yield comes in Bitcoin. If you deposit, comes in dollars. Then with staking is actually paid by the digital asset network itself. And the reason is that you are providing a service to the network. Let me explain. In the case of Bitcoin, miners are used to process pending transactions. Every 10 minutes, there's a huge pool of pending transactions. Miners are playing a game in the background, trying to solve these math puzzles. Whoever solves the puzzle first not only wins some Bitcoin, but they process all of the pending Bitcoin transactions that they can fit into the next block, right? There's only so many, it's like a checkbook where you can only fit so many transactions in a page. And then every 10 minutes, somebody wins the right to create a new page. That's very computationally expensive, and it's very expensive in terms of electricity, but it's unbelievably powerful and secure, okay? Now, Ethereum and Solana and a few other networks have decided that that level of security and power is not required to process transactions on their networks. They've taken a different approach. Instead of the proof of work that I just described, they use what's called proof of stake. By basically staking your Ethereum or Solana,
meaning, and by staking, you mean posting your coin.
Posting it on a smart contract somewhere and just digitally signing something. My Solana is here, and it will actually validate pending transactions for the network. And in exchange, the network will pay me more Solana. And that becomes effectively a natural yield or a natural rate of return, which is totally safe because it's not a loan, right? And so that proof of stake is highly scalable, doesn't use a lot of electricity, but it does represent a safe natural yield on these kind of alternative protocols like Ethereum, Solana, Sweep, Aptos.
And what kind of returns are we talking about from yield and staking? How profitable is this?
It depends on the asset, but for stakeable assets like Ethereum and Solana, generally the staking rates range from like anywhere from 4 to 8-ish%. For yield, Bitcoin, it's probably 3 to 5, maybe 3 to 6%, depending upon what's happening. Dollars, a little higher, probably 4 to 7%, depending on what's going on. I think you're going to see a lot of people interested in dollar stablecoin yield as bank yields are coming down in the coming months. But anyway, that's the basic idea.
And are these gross or net?
I'm giving you gross numbers. Yeah. But like in the case of Bitcoin, it's great because the yield more than covers any management fees.
So I think most folks are familiar about the difference between Bitcoin and Ethereum. But what about, explain for us, Ethereum versus Solana?
Sure. So Ethereum was originally developed as literally an extension of Bitcoin that added programmability. In other words, smart contracts. Think of it like programs that could actually run on the internet that would use Ethereum, their digital assets, as almost like coins in a slot machine to execute the programs. And these programs, in theory, could do anything, right? And the challenge with them is they're very expensive to run. And you would notice this in the last kind of bull market, because doing transactions on Ethereum might have cost anywhere from $10 to $50, right? It would be like, going to a Chuck E. Cheese arcade and all of a sudden the token cost a penny, and then by the end of the night it costs $20. Well, your interest in playing a game, if it costs $20, probably just went down significantly, right? Especially if the prizes are still the same, and that's what's happening here. So now we have these next generation networks like Solana that have basically created a massive throughput. Their goal is to be as scalable as Visa and MasterCard in their ability to process massive amounts of transactions, but still remain decentralized the way Bitcoin and Ethereum are decentralized. They're not quite there yet, but the scalability numbers they're showing are enormous. Solana is now doing more transaction volume many days than Ethereum, which is truly remarkable given how scalable Ethereum even was, right?
Ethereum says that they're going to be creating a new upgrade that's going to dramatically accelerate its capacity, I think partly to stay competitive against Solana.
Exactly.
Do you have a personal viewpoint of bullishness, Ethereum versus Solana?
I think that Ethereum is never going to scale to the ability that, the Solana and the next generation Aptos and Sui networks is able to do, but it's hardened, and I think it will work well for institutional applications. So I think the BlackRocks of the world will probably tokenize assets using Ethereum because they're not so concerned about the cost of a transaction. If it costs $20, so be it, because they're talking about, billions of dollars of tokenized assets. I think for mass market, massively scalable retail applications, I think Solana is winning. If I was developing, for example, a neobank right now in Brazil, I would be doing it on Solana, not Ethereum, because my transactions would be free, right? So that's the difference, right? I think you'll see a lot of retail apps, games, payment apps being built on Solana, a lot of tokenization, institutional apps being built on Ethereum. And Abra doesn't care. We'll support all of it.
A couple of practice management questions. One, can somebody open with you at Abra only taxable accounts, or can you do IRAs and Roth IRAs?
I think you can use this as a crypto component of an IRA if the IRA provider supports that. I may have said that wrong, but if you follow up with me afterwards, I can talk to the team and get that answered 100% correct in case what I said is not correct.
In other words, if you're dealing with a self-directed IRA and that self-directed IRA custodian allows crypto, then they would allow a crypto SMA, such as what Abra. Yeah, right. I think that sounds about right. And I would think that Choice, for example, is one IRA custodian that allows crypto would facilitate. So I think that answer is right. And I think, yes, people should contact you to delve into that. What's the relationship between you and traditional custodians like Schwab and Fidelity?
Yeah, today the systems are completely separate. They don't support digital assets today. Fidelity supports Bitcoin, but even that is completely separate from its traditional asset management business, as I understand it. And then the Schwabs and the other ones don't even support it at all, as far as I'm aware. And many of them don't even support the ETFs yet, which is crazy. But it's coming. They will. And so, as I said, part of our goal going forward as we support RIAs directly is to figure out what all of you want to have happen. Do you want to keep these things separate? Do you prefer that we integrate with existing BDs? and custodians, et cetera, and we're thinking through and having discussions on those requirements for now. But what we've built is quite sophisticated, and many of the BDs simply couldn't manage this today.
Like you said, long term, everybody's going to be doing everything because it's the wave of the future.
Absolutely.
Michael's got an interesting question. He something you said caught his attention. Why would staking yields stay high if bank treasury yields are going down?
It's a lending marketplace, so the two have nothing to do with each other. This is based upon supply and demand within the digital asset space. And so if, for example, if the Bitcoin price is screaming higher and people want to borrow against the value of Bitcoin, partially to buy more Bitcoin, which you're totally allowed to do. Let's say you're holding $100 worth of Bitcoin and you want to borrow $10, right? So you have 10% leverage, which is very tiny, right? But if everybody's doing that, the demand for borrowing dollars is going to go up significantly, right? And so therefore the yield on the Bitcoin will come down, and the interest on the dollars, the interest rate on the dollars is going to go up. So again, it's a two-sided marketplace between yield and lending, and that's how these rates ultimately get set, as opposed to the treasury markets and the bank, repo markets, which are completely manipulated. This is a completely open, free market where the market sets the rates.
This is a really cool question I like a lot from somebody who is anonymous, but I really love this question. Here's what they say. What about the concept that if this gets too big, the government will feel threatened and therefore make all crypto illegal? Wasn't that done in the 30s by FDR with gold?
Yeah. So there's a few key differences here. One is this is global, always on, 24/7, and you really can't shut it off. What you're talking about here is more related to free speech rights than it is commerce rights, right? I would posit that if somebody had challenged the 1930s, ideas today, they probably would have been deemed unconstitutional. But that issue aside, the Supreme Court has already opined on, the streams of ones and zeros as free speech, right? And so it's going to be extremely difficult for any government regulator to come in and say people who are accessing DeFi directly, right? Even if they're bypassing an RIA and just doing it themselves, if they're, maybe they're computer science majors, for example, and know what they're doing. The point being, the Supreme Court has already said, look, software programs in that regard are free speech, right? And so, I think that ship has sailed.
So I've got a question as a follow-up to something you said earlier. This comes from Ernest, and I want to, before I get to Ernest's question, which is a good one, I want to go backwards a little bit just to recap your description of the relationship between the investor, the advisor, and Abra. Yep. So talk about that mechanism again.
Yeah. So today Abra is the advisor. Okay. So there is no tri-party relationship today. That's something that we're considering now how to offer going forward. So if there are advisors here who want to offer this to their clients, they should definitely get in touch with us. We're having discussions with many such advisors now, trying to figure out all the requirements. In terms of the relationship between the investor and Abra, we are their advisor as it relates to digital assets. The form ADV is available on our website. We can link to it here, but it's there for everyone to see. Has pages and pages of risk disclosures related to DeFi and everything else we're required to do and to provide. And they're signing the investment advisor agreement directly with Abra today, using the custodial model that we described and discussed earlier. We are interested, as I said, in initiating tri-party agreements between RIAs, clients, and Abra, where the clients can retain their direct relationship with the client and effectively use Abra as the advisor for purposes of instantiating these digital asset investments. And we're extremely interested in talking with anyone here who is interested in pursuing that.
And once that is established, first of all, do you have a timeline? Do you have an expectation of when you'll launch that?
There's simple versions of that we can probably do now for some RIAs, but the real solution where there's multiple user approvals and reporting integration and all the requirements is a solid 6 months out, I would say.
Okay.
Yeah.
And when that's in place, how would the advisor who brings a client to you, how would the advisor earn their fee?
Yeah, the advisor can basically set their own fees at that point. And then, our fee would simply be a service provider fee integrated into the mix, and then their fee would be net of that. So, and our fees might actually come down in that case, but TBD.
So
the goal would be that the advisor should always be able to set their fees.
And I think it's pretty common whenever advisors are dealing with third-party asset managers or providers. I don't think it's terribly uncommon, such as self-directed IRAs, for example. In our closing minutes here, Bill, it's been fascinating information. I think it's new and different for the majority of advisors. So make the case for why advisors need to be paying attention to this and what you think they ought to do as first steps.
Well, one, get educated, right? I mean, on the basics, right? And that's why we're doing this is, what are people doing in crypto, right? The three things that I mentioned. They're holding Bitcoin, they're earning yield and staking, which I'm grouping together. They're borrowing against digital assets. Understand the mechanics. You don't have to understand the computer science of this, but just the mechanics of how this works and why people are interested in this, right? And this does not require thousands of hours of effort. This requires, literally days of effort, right? Not even weeks and months. It's just the basics. If you understand that, it's very difficult to ignore the fact that there are 50 million Americans who are touching digital assets now. There are many boomers who are bypassing traditional investment opportunities now. And like I said, once you start going down that rabbit hole, it's, as many of the people here who I've spoken to one-on-one in the past have told me, it's very hard not to keep going down the rabbit hole once you've started. But that's what I would do first. And then look, if you're as convinced as I am that this is something that your clients want, then just get in touch with us and we'll talk it through.
Yeah, it's not as challenging as it may be. And I'm going to take your days of education to get up to speed on this by talking about our CBDA program. I encourage you to become certified in blockchain and digital assets. This is an awesome 18-hour program. You get 18 CE credits, and it teaches you what you need to know, both about the technology and the practice management elements of this, so that you really know what you're talking about and you can have intelligent conversations with folks like Bill to understand how you can integrate this into your business for the benefit of serving your clients. Through our course, which is an online self-study, take it at your own pace. People have binged it in a weekend. The average is 10 days to complete it. They do a track a night over a couple of weeks. We have a track specifically for advisors, another for home office, and another one for investors and consumers, as well as a foreign language track that's in 9 languages. So yeah, I think, Bill, you're absolutely right. It all starts with education, and our CBDA is the best way to get about doing that. And you can tune into my daily podcast where we talk about crypto and so much more. This entire month, I'm focusing on the election, of course, and encourage you to do that. So, Bill, this has been really terrific information and very fascinating. As I mentioned, you should download, if you haven't already, the deck that we have pushed to you here on Zoom. Bill would be really happy to talk to you to learn more about your practice and how Bill might be helpful to it. Bill, thanks so much for joining us on this program. Really appreciate your time today.
Thank you, Rick. Always good to see you. Thanks, everyone, for joining. Appreciate your time.
Thanks, everybody. See you soon.